Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 29th of May. I'm Daniel Lam, your host for the podcast. In my business visit to our Singapore office last week, many have asked me about my thoughts on the weakness in Hong Kong China markets. Indeed, the Hang Seng Index made its year-to-date low last week. And not only that, European equities, which a number of investors have been utilizing as a China proxy since the end of last year, have underperformed US equities by nearly 5% from their previous peak about a month ago. In terms of specific proxy sectors, last week was the worst week for European luxury goods stocks since last December. The sector shed 6% from their peak a month ago. Materials in DMs have also come under pressure over the last month due to lower than expected Chinese growth data. The question now is, how far do we see this Chinese equities sell off? Well, investor positioning suggests that there is perhaps a little bit more room to go. First of all, the China A-shares flow. The 20-day rolling flow reached more negative levels in past troughs compared to the current level. So at this moment, it is minus 1.5 standard deviation versus the negative 2 to negative 3 standard deviation seen in the past. Now, for European equities, the CTA level is still more stretched compared to the US, suggesting potential further correction in European equities. And European luxury goods, hedge fund long-short position is at 72nd percentile versus history, so i.e. it is still elevated. And finally, the copper CFTC net position is still above previous troughs. Technically, Hang Seng Index broke below the 18,829 level, which was the trough year-to-date. The index had been gapping down 2 sessions in a row. So if it breaks below 18,400 level, then it opens to further downside to 17,700. The index must recover fast above the critical 19,800 level for the Hang Seng Index to resume its uptrend. Now, however, putting things into perspective, the US and European economies are likely to face recession over the next 6 to 12 months, and the China economy is still delivering reasonable growth. Thus, for the medium to long-term investors, they may look at the positioning indicator aforementioned, as well as watching out for these critical index levels in order to look to add to Hong Kong China equities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.